China is undergoing an exodus of foreign firms as per surveys and published opinions from economics lobby groups and business consultants in the country. Moreover, the pace of companies leaving China is stimulating, causing a ripple effect that threatens economic recovery after the COVID-19 situation. The exodus also presents a challenge to President Xi Jinping's dual circulation plans, which aims to reduce China's dependence on foreign markets by increasing domestic consumption. Consequently, Chinese officials are struggling to slow it down. Hello everyone, welcome to World of China, a channel to explore China. In today's video, we are talking about China's economical crisis and why major foreign companies are leaving China's market. And is it linked with a global trade war with the US? So stay tuned and give this video a big thumbs up. It's not breaking news that manufacturing is leaving China. Over the last 20 years, China manufacturing has dominated over the rest of the world. This was driven primarily by optimized shipping lanes and extremely cheap labor rates by way of government subsidies. These two benefits made enough sense financially for brands to endure quality issues, shipping timelines, communication barriers, and annual production delays during the Lunar New Year timeline. However, in the last 3 months, Chinese manufacturing got hit by what can only be labeled as a perfect storm of conflicts. A mixture of long-standing issues and new challenges such as high tariffs, COVID-19, and increased geopolitical tensions have resulted in a mass exodus from Chinese manufacturing and triggered the start of the downfall of the country's manufacturing dominance. Understanding what might make China fail, however, requires an understanding of what made China's manufacturing economy so successful in the first place. As the US-China trade war rumbles on and relations between other liberal democracies in Beijing deteriorate due to everything from intellectual property theft to human rights violation in Xinjiang and the eroding of Hong Kong's liberty, many globally renowned companies are deserting China. Research firm Gartner revealed last year a third of supply chain leaders had plans to move at least some of their manufacturing out of China before 2023. Coronavirus-related sales slumps and supply chain disruption, as well as rising production costs, have also accelerated the exodus. China grew to become the world's factory over the last 40 years. This started with former President Deng Xiaoping ordering an economic reform in the late 1970s and introducing the concept of a free market to China for the first time. All of a sudden, a blend of loosened state regulations, access to the world's largest, youngest workforce in the world made China the perfect place to outsource manufacturing. Cheap labor rates and proximal access to quickly growing consumer populations in Southeast Asia made China one of the most profitable business hubs in the world. It quickly overtook the United States in 2011 to become the world's largest manufacturer, driving growth in the nation's GDP by 40%. Over these 40 years, the world around China also underwent an enormous digital transformation. Consumer electronics generated homes and workplaces with paper and pens replaced by phones, tablets, and computers for nearly every knowledge worker. Through quick planning, China was able to quickly adapt its manufacturing capabilities and develop specialized industries like electronics and PCB manufacturing. Entire cities like Shenzhen were constructed for the sole purpose of enabling more rapid manufacturing of consumer electronics. This maturation point in China's exponential growth curve, however, led to a few unexpected circumstances. The price and speed at which China was able to produce goods started to slow as the country's population grew, and its presence on a global stage drew attention around environmental and wage regulations. Specializations on a global stage drew attention around environmental and wage regulations. Specialization drove labor rates up, resulting in the average manufacturing hourly labor rate setting at about $6.50 an hour, up almost 20% from previous years. A global trade war with the US spurred by the Trump administration also dealt a fatal blow towards Chinese manufacturing. This has resulted in not only reduced export volume to the US, but also to other countries facing American pressures to reduce global dependency on Chinese manufacturing. Analysis reports that Chinese exports globally have been estimated to drop by $25 billion since the tariffs were first implemented. And amidst geopolitical uncertainty, COVID-19 has pushed Chinese manufacturing to the brink of shutdowns. The Lunar New Year, followed by immediate COVID-19 shutdowns, created bottlenecks throughout the supply chain. Raw materials weren't sourced fast enough from upstream suppliers, creating delayed lead times and choked end customer deliveries. COVID-19 forced much of the West to fundamentally rethink the risks of over-reliance on Chinese investment and supply chains. The The EU struggled to access medical equipment and personal protective equipment in the early days of the pandemic after China nationalized production and exports. That's made clear the risks of relying on just one country for critical goods. COVID-19 also showed China's increasing willingness to use economic coercion as a foreign policy tool. No country in Europe wanted to be the next Australia, whose coal ships were stranded for 9 months in Chinese waters as Beijing and Canberra faced off over calls for a World Health Organization investigation into the origins of the coronavirus. For modern US companies, both startups and giant supply chain risk has been top of mind. Companies are expanding their supply chains to lessen risks earlier and earlier in their production cycles, leaving no risk of being caught empty-handed for the next global pandemic. Make no mistake about it, the trade war is remapping global supply chains to the detriment of Chinese manufacturing. The percentage of China leaving businesses surveyed by Quality Control and Supply Chain Auditor QIMA was 80% for American companies and 67% for those based in the European Union. QIMA has more than just anecdotal evidence. Demand for their China-based audits dropped by 13% as mainland manufacturers are either losing their foreign clients faster due to costs associated with tariffs or are relocating part of their manufacturing out of China to avoid those tariffs. European companies are less affected by the trade war because their countries have not slapped tariffs on Chinese imports. But QIMA thinks they have their reasons to reduce their dependence on China manufacturing. Most are diversifying throughout Southeast Asia and closer to home. This ongoing diversification of the global supply chain creates ample opportunities for corporate investors and gives rise to new markets in countries like Vietnam, now getting the equivalent of a steroid shot to muscle up their economy. This raises an interesting question. If manufacturing is leaving China, where is it going next? Amidst numerous attempts to drive reshoring efforts, US manufacturing still suffers from problems of labor skills and wage costs. Tariffs have succeeded in lowering global dependency on Chinese manufacturing, but they have failed in driving manufacturing back to the US. Global consulting firm Deloitte recently ran a report around expansion and optimization of US companies' manufacturing bases. Upon surveying hundreds of production executives about decision-making post-COVID-19, the report highlighted top goals for brand new executives when deciding where to expand new manufacturing bases. These include new market opportunities, proximity to existing accounts, talent availability, educational infrastructure, business disruption risk, state technology advances. Accordingly, given the proximity to a ballooning population base and relatively lower wage rates, Southeast Asia remains a fruitful opportunity for brands looking to outsource manufacturing. Conveniently, as Chinese manufacturing began its decline, other Southeast Asian countries nearby started quickly gearing up to take over some of the Chinese business. Individual countries started eating up niche specialties. Vietnam, for example, made massive efforts to grab everyday attire manufacturing. Popular sportswear brands like Nike and Adidas have rapidly reallocated a vast majority of manufacturing and footwear based to Vietnam from China. Thailand has seen an increase of about 19.7% export volume from the US, specializing in automotive, food and beverage, and natural rubber manufacturing. Thailand also offers some competition to China in electronics manufacturing. Indonesia has also appeared to be a new player in this space, appearing particularly attractive for companies seeking to relocate from China. President Joko Widodo of Indonesia has been incredibly intense to jump on the Chinese manufacturing exodus by presenting close to $1 billion in federal investments through the creation of an industrial park in Java, Indonesia. India, another global superpower with a quickly expanding consumer base and previous manufacturing know-how, is also attempting to reclaim a spot as a world exporter. India already has a massive auto, food, and apparel manufacturing base. Apple recently released a plan to start manufacturing the iPhone 11 at a Foxconn-owned CM plant in Chennai. There's also talk of the assembly of an iPhone SE 2020 at a Western plant near Bangalore. Pharmaceutical companies are also turning towards Indian manufacturers for a more reliable production base. Most notably, AstraZeneca will be utilizing Indian contract manufacturer, the Serum Institute, to manufacture its newest COVID-19 drug. Mexico and Brazil have also grabbed the spotlight and gained huge manufacturing market shares in the automotive space for both internal country production as well as export purposes. Amidst the stagnation of Chinese production, it's critical to recognize China's success in manufacturing as well as its potential to clutch its role in some portion of the world supply chain. Manufacturing executives globally still look to Shenzhen for supplying microelectronics from Peloton components to phone chargers. And if properly handled, China might be able to save itself from a manufacturing-driven economic freefall by fastening itself in as not necessarily the world's everything factory, but the world's electronics factory. Shenzhen still retains the ability to be the world's leader in electronics development, specifically for post-fabrication and assembly portions of the supply chain. Through investment in operational efficiency, customer satisfaction, and supply chain transparency and simplicity, China can continue to serve as a preferred partner for global companies. China went from being a low-income nation to enduring a period of enormous growth through specialized manufacturing. As the world became more dependent on software and robotics to automate every part of our homes and workspaces, China ramped up production to deliver on that dependency, developing strategic trade corridors, investing in marine safety to guarantee a US-China shipping lane, and pouring massive amounts of infrastructure into port systems enabled China to quickly rise to power as the world's preferred manufacturing partner. But at the end of the day, a rise in labor rates and more globalized calls for regulations have driven up prices of Chinese manufacturing, forcing not only international companies but also Chinese-based ones to turn elsewhere for their supply chains. Over time, China developed a niche in electronics manufacturing, effectively constructing and scaling the city of Shenzhen to greater than 20 million population between 1998 and 2017. As the world's desire for electronics grew, China specialized to meet demand by cutting new tooling and developing a new workforce specializing in lower-end electronics production. But with this came downsides. A more specialized labor workforce pushed up wage rates, driving companies to move manufacturing bases out of China to other Southeast Asian countries. All eyes will be on China over the next few months and years to see if they can continue to remain their global manufacturing presence in the post-COVID-19 economies. Well, that's all for today. Thanks for watching this video. If you have enjoyed this video, then give this video a big thumbs up and share it. For more exciting videos, subscribe to this channel and hit the bell icon. I'll be back with another exciting video soon. Till then, check out our channel for more exciting videos and stay tuned. Check out why LinkedIn and Microsoft left China. The link is in the description below.